Hello, everyone, and welcome to this latest episode of the Bull and the Bear podcast. I'm money and markets research analyst Matt Clark, and host of the Bull and the Bear. Glad you're with us this time around. We took a bit of a break. Charles and I had a podcast earlier this week, and it was the first one we've done in a week. I had an unfortunate death in the family, but we're back, and we're back to full schedule and full on, and it's a good time for it. I want to jump right into today's podcast before I start talking about how you can listen to us and all that. By now, most of you probably know, but just in the event, I'll run through that down at the end. But I remember a time when I was younger. This was probably in the 80s, which I know to some was like, really? That's younger? But the economy was doing well. There were jobs everywhere. I lived in Wichita, Kansas at the time, and Boeing was a massive employer, and they had more jobs than they had people who could fill for the aerospace industry. The economy was moving in a great direction. We all had a lot of confidence about the future. And in fact, if you remember, over the last 11 years up until just recently, we've had the longest bull market run in stock market history. Times were great. I mean, we were spending money. We were buying cars. We were buying televisions. We were buying new computers that were coming out. We were new phones every year. All those things. We had cash in our pockets, and it was burning a hole in it, and we just couldn't wait for the next thing to come out to spend our money on. But things have changed most recently, and the coronavirus is a big player in that. And businesses have kind of have either trimmed back or closed altogether. Unemployment is still high. I know that we had some good news this week in terms of jobless claims. They were about 860,000, which was better, but still unemployment still remains very high, especially when you consider we were under 4% at the first of the year. But what it all means is that when you have an economy that's in question, you have a job market that is equally in question, if not more so. As consumers, when we talk about where we're going to spend our money, we really, at least you should be, drilling down to the essentials, and that is paying your mortgage, paying your rent, paying your bills, paying whatever those essential things are. And then your next tier is, what do I need at the grocery store? And it's going to come down to, what do you absolutely need? You need food, you need various sundries like toilet paper, paper towels, water, yada, yada, yada. And the very last thing, if there's anything left, if you feel comfortable, is what you would call discretionary items. And this could be electronics, this could be a car, it could be vacation, it could be whatever. And the amount of money we're spending on those is becoming less and less and less because there's just a lot of uncertainty out there. And one sector that tracks that particular area dropped about 34% thanks to the coronavirus crash in March. But things are starting to turn around a bit. If you look at the S&P 500 Consumer Discretionary Sector ETF, it trades under XLY. It's an exchange-traded fund that tracks some of the biggest consumer discretionary stocks, and this ranges from hotels to retail stores to it's a very large swath of what it covers. It's actually jumped about 70% since reaching its low back in March. It topped out at about $153 a share at the 1st of September. It's at a slight pullback. But this particular ETF of XLY holds companies like Amazon, Home Depot, TJX Companies, which was probably one of Charles's favorites as the parent company of discount chain TJ Maxx. If you remember what he said about Ross, very similar thing there. So I want to talk about and kind of zero in on consumer discretionary companies today. And we picked out three, and these are all three that you have undoubtedly heard of, dealt with, shopped at, utilized services for. There's no question in my mind that 99% of the audience who's listening to this knows exactly what these stocks are. So these are big stocks and they're big companies. And I want to talk to Money Markets contributor Charles Sizemore and Chief Investment Strategist Adam O'Dell and kind of get their take on it. I'll give you mine as well. But let's jump right in. The first company I want to talk about, it operates an online marketplace. It matches buyers and sellers around the world. It also utilizes mobile apps to facilitate that matching. Outside of the United States, interestingly enough, this is something that probably isn't necessarily as well known about this company. It actually operates several online classified marketplaces where people can post and look for things like jobs, rentals, goods and services, things like that. And they don't do it here in the U.S., but they do it in other countries, Germany, I believe the Netherlands, and Scandinavia. They do it there, and it's widely popular. Now, in terms of its stock, since reaching a low of about $26 a share in March, the stock has jumped 100%, exactly 100%. And that's not even at its highest point because it's pulled back over the last couple of weeks. last couple of weeks rather. The company I'm talking about is eBay Incorporated. It trades on the NASDAQ under EBAY, and this is a very large company. It has been around for about, I want to say 20 years. I could be wrong. And it's really developed its niche in terms of an online marketplace. So first I want to bring in Charles Sizemore and get his take. And first off, Charles, welcome back to the Bull and the Bear. And give me your thoughts on eBay. This is a pretty popular website, and it's one that's been used for years now, and people have even found a way to create storefronts, literal brick and mortar storefronts for eBay shipping and receiving, which is kind of an interesting offshoot. But give me your take on eBay.
Yeah, sure. Another aspect of eBay that's underappreciated is they're the owner of Venmo, and Venmo, the popular money sharing app. I know people that actually run businesses on Venmo. I wouldn't do that, but people do. At any rate, eBay has had a fantastic run this year. They really have, along with the rest of the tech sector. So even though eBay is getting lumped in with these consumer-oriented stocks, it's also a tech stock at the end of the day. And by virtue of being a tech stock, by virtue of being a NASDAQ stock, it's really participated in what's one of the most epic runs in tech stocks in history. I would say I think you're late to the party on this one at this point. I would probably pass on it for now. It's been sort of consolidating now for several weeks. That's not to say that it couldn't hit a short-term bottom and go to the moon from here starting tomorrow. But I feel like this one has sort of made its move, and I don't know what catalyst coming down the pipeline is going to cause it to go significantly higher from here. To me, this looks like one that might perform in line with the market. I don't see it outperforming in the near future.
It's pulled back. Do you think it could retouch those highs that it had a couple of weeks ago?
Sure. I mean, if the market as a whole just goes higher from here, the market finds its bottom and pushes higher for the last quarter of this year, then sure. I mean, eBay will probably participate in that. I think if the market goes generally higher, then eBay will participate in that. I just don't see what that catalyst will be for it to outperform at this point. It's had a fantastic run this year. If you were in eBay earlier this year, props to you. You really picked a winner. I just don't see, I don't see the impetus for it to do significantly better than its peers going forward.
Okay. Money Market's Chief Investment Strategist Adam O'Dell. I know you and I are ones, we look at the numbers and we look at the technical side of things, and technically in terms of ratios and return ons and things like that, eBay still looks very, very attractive. But what do you agree with Charles's sentiment in terms of maybe that it's kind of past its prime?
Yes and no. On a short-term basis, when I make a short-term decision on a stock, whether it's a good time now to get in or whether you should wait, a few to several months, I often look at my cycle 9 alert algorithm and signals. And what I actually saw on eBay, in full disclosure, I didn't recommend this trade, so this isn't a trade that my readers were in necessarily, but cycle 9 did give a buy signal on eBay right at the end of April. So, once that recovery was already underway, some stocks were just regaining, 30, 40, 50% of what they had lost in the February, March sell-off. But eBay by that point was already pretty much just under its February highs at that point in late April when it gave me a cycle 9 signal. So those signals are usually most effective over a 3-month period. So that was late April through late July. Over that time, the stock went from about $38 to $58, and it was just, basically got out right after the most recent high at $60. So that was really the best run in eBay. Since then, the stock has pulled back. It's made a couple lower lows and lower highs. So it's kind of in a pullback flag pattern. It's still trading above its 200-day moving average. So the way I see it is it could fall a bit further before it hits that 200-day moving average and finds some support. So I would be holding off on buying eBay right now. Part of that reason is more of the macroeconomic and the broad market picture as well. As Charles pointed out, I mean, if the market continues to scream higher, then I see no reason that eBay won't also continue to perform, make new highs above 60 and even outperform the market. But one thing I think that's benefited eBay in this early part of the recovery post-COVID is that it's an online business. It is not disrupted by having people in stores and out in the streets. And this consumer spending, discretionary spending, hasn't really taken a hit quite yet. And partly that's because this pandemic hasn't hit everybody the same way. Certainly restaurant workers and a lot of people, millions of people are out of work. And it's super unfortunate, but there are also a lot of people that have been able to work seamlessly from home for now. But if we get something of a double dip, or if the recession lasts longer, if there are continual knockoff effects, if there's a negative feedback loop, then I could see consumer spending taking a hit more so than it has on much more of a lag. And at that point, there's still going to be as many people shopping on eBay or sending money through Venmo. I'm a little bit less confident in that. So I would kind of be like a wait and see buyer of this. I think eBay has a strong brand. Is very few competitors. I mean, it's been in the business for multiple decades and it's been through a lot of different cycles, has not really been disrupted. So I think it's a great stock to keep in your back pocket and you want to own for the long run, but I don't see right now as the ideal entry point.
I agree. I think it's a great company. I think it's had a great run over the last several months. But I think it's starting to see a little bit of a drop off. Will it hit its new highs? I kind of disagree in a way with Charles. He really wasn't, it wasn't a committal thing. I don't think it will. I think it's going to pull back a little bit more. I don't think that now is the right time to jump into eBay. Is that to say that, it's never a good time to get into eBay? Absolutely not. It's a great company. I think it's got great fundamentals. It's got great technicals. I think Adam's right. You just want to find the right time for it. Second company on our list today it's a retail company. It specializes in technology products, selling technology products. It's very big in the U.S., Canada, and Mexico. It has a 3-year annual growth rate of sales of 3.4%. Its sales for the trailing 12 months total $43.4 billion. Its share price bottomed out at around $50 a share in March, but has jumped 123% since then. Which is pretty spectacular, all things considered. And the company that I'm referring to here is Best Buy Company Incorporated, trades on the New York Stock Exchange under BBY. And I'll first throw this to Charles. Charles, the stock hit a golden cross back in mid-July. It's been on fire. It's really kind of weathered the storm in terms of other retail outlets that have taken a pretty significant hit. So give me your thoughts on Best Buy.
It's funny. If we had this conversation back in April, I would have said, "Ooh, Best Buy is probably toast." Stores are locked down to the extent you can go in the store at all. They're having to limit the number of people in there. They're trying to do curbside delivery, which, I mean, that's kind of weird. If I'm going to go buy a big TV or something, I want to look at it first and kind of poke the buttons and play with it before I don't want to just have someone take it out to my car because I saw it on the internet. I would have been completely wrong. I'm the first to admit I would have had this one wrong. What's happened instead is because people have been stuck indoors more, because people have not been able to do a lot of the entertainment things that they would have done pre-COVID. They've been buying more toys. They've been buying that. If you're going to be at home watching Netflix more, you might as well do it on a nicer TV, right? And so that's part of what we've seen. So I would say I would be a buyer here. The stock has a lot of momentum. The basic story is unchanged, and we're now coming up on the most important quarter of the year for retailers, the Christmas shopping season, of course. That does bring up some interesting points. There are some really big potential hurdles here that we do have to look out for. If we do have, it looks like we're already kind of in the middle of one, but if the COVID cases really start spiking when the weather starts to get colder and we have to kind of clamp down on certain activities again, or if people are just scared, people are thinking, you know what, not going to go risk my life to go buy a TV or whatever, I almost said DVD player. Wow, I'm showing my age. Nobody buys DVD players anymore. A Roku box, whatever. I'm not going to go risk my life to buy a Roku box. I'll just buy it online at Amazon, or Best Buy does, of course, have a website. But I would say, the one real big roadblock we need to look out for is just if shoppers stay away from the stores and this ends up being sort of a lackluster Christmas shopping season, then that could be a problem. Now, I don't necessarily think it will be. Because what we saw is even though unemployment went through the roof, a lot of that was mitigated by the enhanced unemployment benefits. And while that has completely trailed off at this point, do you really think that they're negotiating? The White House and Congress are negotiating for additional aid packages. They're going to do everything they can to keep the money flowing into retail. So I would say Best Buy is a buy. I would say look out for any, speed bumps in the Christmas shopping season related to COVID or anything else. I think that's something you should watch out for. I don't necessarily think that's going to be a problem, but if there is going to be a problem, that would be it.
See, I think that the bigger headwind is something they've already faced, and that is the shutdown due to the coronavirus. I think even if there is a lackluster Christmas shopping season, obviously that will take a hit to any retail store. But I think Best Buy can no pun intended, weather that because of how they performed over the course of this
Think
lockdown.
about Black Friday, though. Black Friday where people, form
but see,
a mile-long queue outside
Black
the
Friday is
door.
no longer a thing. Black Friday is not nearly what it used to be. Black Friday used to be just that. It used to be long lines of people standing outside the Friday after Thanksgiving. Now stores are open. They're providing deals a week in advance. They're opening on Thanksgiving for some reason, just because they feel like they need to get out ahead of that. So I just think that shopping season, I read something actually today, that shopping seasons are actually for holidays are actually starting in the middle of October, because that's when companies when retail outlets are going to start giving their big holiday sales. So really, I think that the whole shopping season, first off, now seems to be elongated, and two, has really lost that Black Friday impact. I don't think smart retailers are really pricing in a massive Black Friday, because I just don't think it's there anymore.
Well, another issue as well is Best Buy has invested in their online presence. So even if people stay away from long lines, they stay away from crowded stores because they're scared or because they're required to by law. Either way, the website presence does help. Now, again, I still think this. If there's going to be a speed bump, I think this is it.
Right.
But I think there's enough things in place here to mitigate it.
Agreed. Adam O'Dell, your thoughts on Best Buy?
Yeah, I'm actually cautiously positive and bullish on Best Buy as well. I mean, as a company, it is quite a success story. I mean, if you think about the whole storyline that's been happening for upwards of a decade now, the death of retail or the death of brick and mortar stores, you certainly would have, as Charles said, put Best Buy in that and bet against them. But I mean, if you look at Best Buy's stock in 2013, when all the other stocks were soaring to new highs, Best Buy was trading below its 2008, 2009 bottom. So it's really, had a tough go at the beginning of this bull market, but it's kind of really gotten its feet in the latter half of the bull market. And I think that just speaks to the business's ability to adapt. I mean, it's competing against Amazon, but for some reason, we can speculate why. A lot of folks are still willing to go to a store or to pick up curbside and flip up the tailgate and have somebody load up the TV in the back, rather than getting these electronics delivered from Amazon. So I think that they've been able to adapt with an online presence, with also offering the in-store experience, and they have people that can come out to your home and mount the TV on the wall or fix the network that you've been fiddling with. So that to some people, especially outside of the COVID environment, is a plus that Amazon will never be able to give people. But as far as I look at stocks kind of on a long-term and short-term basis. On a short-term basis, cycle 9 is currently in a trade on Best Buy. Again, I haven't recommended that to subscribers in full disclosure, but as far as the signal, it's there. It still has about another month in that. As far as a longer term, I look at my Green Zone Fortunes 6-factor stock ranking model, and it rates a 93 out of 100. So it really only gets kind of a poor score on size, because it's a very large company at almost 28 billion, which is large, but not huge. But nonetheless, Best Buy gets scores of like 92 on momentum, in the 70s for volatility. For value, it rates 85 out of 100, so it's priced fairly well, even though it's making new highs. And quality and growth are in the 90s as well. So all around, I think that the business has proven itself to be able to adapt to a number of different disruptions in this current cycle. And I think it's been able to compete with Amazon. Realize that just because Best Buy is smaller than Amazon, and Amazon does so many more things than Best Buy, you don't get any points as an investor investing in the stock that does everything. You get points for investing in the stock that creates the most value for shareholders. So I think that Best Buy is definitely a buy right now. It had something of a pullback, and then it's kind of up the past 4 or 5 days out of the past week. So if you are wanting to get in, I'd get in now and put a tight stop kind of below the recent lows, and hope that the bull market continues on.
And I agree. I think Best Buy is a buy. I'll tell you one thing. We talk about the online adaptation, things like that, and Best Buy has done a great job with that. Their Geek Squad is another addition to provide customer support. But I'll tell you, I think whenever people are looking for electronics, whether that's a computer, whether that's a television, whether that's a, whatever it happens to be. I think when you're looking at electronics specifically, the first website they go to is bestbuy.com. I mean, I would venture a guess that 80% of people, that's exactly where they go. It's not, it's not necessarily Amazon. It's not necessarily that. And I think the in-store experience is great, but there's enough information out there for what you're looking to purchase to find what you're looking for and to help you make that decision without having to go into the store. So even to Charles's point, if they do happen to, maybe lock back down or stores are limited over the holiday season, I still think that's I don't see that being a big issue for Best Buy. I think their return-ons are fantastic, especially when you compare it to the rest of the industry. Their positive return on assets, positive return on equity, and positive return on investments, whereas the rest of the industry is in the negative in those avenues. It's got a very good positive net margin. It's got a very good positive operating margin. It's priced right. I think it has still has a lot of upward momentum potential. And again, like Adam said, his green zone rating system, I mean, it's a 93. What that essentially means is there's only 7% of the other stocks that are rated that are actually better overall. And that says something. And it says something in terms of what this stock can bring you to the table as an investor. So the last company we want to talk about, this is another one that everyone knows about. It was even in the news during the coronavirus, but it specializes, and as soon as I say what it does, everyone will probably immediately zero in on what it is. It's a company that specializes in marketing and selling specialty coffee globally. It sells individual drinks through its brick and mortar stores, as well as packaged coffee, tea, other various things that have to do with the coffee drinking experience. Its trailing 12 months of sales were $24 billion. It has a 5-year annual sales growth rate of 10%. It hit a low of about $55 a share back in March. It's jumped 55% since then. It recently hit a golden cross back in September, first part of September. And the company I'm referring to here is Starbucks Corporation, trades on the NASDAQ under SBUX. And I'll first throw it to Charles. Charles, aside from maybe drinking Starbucks or needing to drink Starbucks, what are your thoughts on Starbucks in general?
I do like my pumpkin spice. That is one of my that's one of my little guilty pleasures.
Who could not wait for pumpkin spice? Who could not wait for pumpkin spice to come out? I mean, really.
I'm always a little embarrassed ordering it because it just, but
I'm not. I'm comfortable enough in myself that I have no problem ordering a pumpkin spice latte or whatever. I'm fine with it.
I respect that. At any rate, so I like Starbucks. You would think in a normal recession, a company like Starbucks would do fine because even though you may skimp on a new home purchase, a new car purchase, those little frivolous luxuries kind of help you get through the hard times, right? People tend to spend more on alcohol, cigarettes, and I haven't seen hard statistics on this, but I would also assume premium coffee. It's just one of those little things that helps you get through the day, right? Things were different this time around because a lot of people pick up that Starbucks while they're on their way to work, right? They stop by Starbucks on the way to work. Well, if there is no work, if you're working from home, you may not go to Starbucks, right? Your routine is broken. And so they really did suffer. I mean, apart from just forced closures of stores, obviously was an issue as well. And the inability of people to linger. I used to just go to Starbucks and read a book for an hour. It wasn't even about the coffee. It was just getting out of the house, right? All of that was dead. And even though it's coming back, it's not back yet. Now that said, as life does get back to normal, people will reassert their old habits. When they go to their place of work, they will go get that Starbucks on their way. And I feel like if Starbucks was able to, hack its way through what's been a very difficult 6 months, they're fine. I think from this point on, it gets better for them. Their international expansion may kind of hit the skids for a bit. I know, their biggest market their biggest growth market was China. I don't know. It remains to be seen what that's going to look like going forward, particularly if U.S. tensions with China if that doesn't diffuse anytime soon, who knows? That Chinese consumer may have as negative an opinion of American brands as, say the typical American voter might have for the Chinese government. These things take time to develop. We don't really know. So that could be an issue that could sort of be a headwind for the next several years. We'll see. But I would say on balance, Starbucks looks great. I would be a buyer here.
Okay. Interesting take. I like that. Adam, what are your thoughts on Starbucks?
Yeah, I'm not so hot on Starbucks, pardon the pun, but as a brand, it's hard to argue against Starbucks. They have obviously a well-recognized brand, and there's a lot of value in that. And I realize they're more than just a brick and mortar location. They've got, K-cups or whatnot. But for me, Starbucks is definitely getting disrupted by the coronavirus. I know a lot of people are thinking oh, this is short term. Let's look past this. But I think that consumers and particularly businesses are going to be making something of a shift. That doesn't mean everybody's going to be working from home forever. But I think some businesses are going to reassess and look at again how they lease office space and where they have their employees. And Charles pointing out, my point exactly is that it's not just people that are going from their home straight to Starbucks. It's people that are going from one meeting to another, or getting out of their office for a little bit to go to Starbucks. And a lot of that foot traffic is going to decline, I think, permanently to some smaller degree. So I just don't see, I don't think, buying Starbucks is going to hurt you, but I don't think you're necessarily going to outperform the market. As far as my 6-factor ranking model, it ranks fairly poorly at a 22 out of 100. Some of that, I believe, is even though my factors do look at longer-term averages, like 3, 5, and 10-year rates, in some cases, I do think that, Starbucks, more so than eBay and Best Buy, took much more of a sharp hit in earnings and revenue growth in the past 2 quarters. So I think that, I do expect that score to bounce back from 20, at least up to 50 or 60 over the next several quarters. But for now, it's just kind of a wait and see. I don't think there's any real impetus or catalyst to have to be in Starbucks at the moment.
Yeah, I look at if you look at the business model and how Starbucks makes its money, obviously brick and mortar is kind of its that's its focal point, and brick and mortar has taken a hit, and I think that hit is going to continue. Now, does that mean Starbucks is bad or its products are bad? Well, no, obviously not. I mean, because you're still going to go out and buy, as Adam said, Starbucks K-cups or a Starbucks mug or some of its ground coffee or whatever, and that's fine. But that's not really enough to really suggest that Starbucks is going to start really upswinging and provide a good amount of profit for an investor at this point in time. I'm concerned about its valuation. Its P/E ratio is around 79. The industry average is 41. I mean, that to me is I question that. It's I think it's a little high in price to sales, very high in price to cash flow. So I think there's a serious valuation issue with Starbucks right now that I think the market is going to realize. So yeah, Starbucks is a good company to get to get your coffee from. I just don't think right now is the time to invest in it. So that's my thought. So to kind of overview it here, as we look at Starbucks, Charles is a yes on this. He sees some good potential.
I may be biased by my pumpkin spice,
and that would be understandable. But
when you read about investor biases, you talk about the recency bias,
right?
The availability heuristic. The pumpkin spice heuristic is also a well documented aspect of behavioral finance.
And if you're interested, Charles and I actually did a podcast earlier this week on emotional investing. So to kind of tail off how his pumpkin spice affects his thoughts on Starbucks, maybe that would be worth a listen. Adam and I are both passes on Starbucks right now. Best Buy, I think we're all pretty solid to buy into Best Buy right now. It's got it's fundamentally sound, it's technically sound, and as we head into the Christmas season, if there is headwinds in terms of maybe lower foot traffic, I don't think any of us really see that as being a major inhibitor to Best Buy sales heading into its fourth quarter. As for the first stock we talked about, eBay, I'm not so much on it. I think Adam's not so much on it. Charles was kind of, I almost think it was kind of nose all the way around. Yeah.
Yeah. I was not a buyer.
So there you have it. If we look at the consumer discretionary sector and three of its larger stocks, all three of these, in all fairness, they do have, I believe, 3 to 4% weight within the ETF that we talked about before, XLY for discretionary sector. So just to toss that in there. But that's our look at the consumer discretionary sector, 3 stocks. Just a reminder that if you do want to listen to the Bull and the Bear, you've got a couple options. You can listen to us by the traditional podcast route. We're on Apple Podcasts, Google Podcasts, iHeartRadio, Spotify. We're also now on Amazon. So if you have a connected speaker or device, just say, listen to the Bull and the Bear, and there you have it. You can pull this up. I actually tried it, and it does work. So I thought that was pretty neat. So make sure that you follow our podcast, listen to us that way. And if there's an option to be reminded when a new podcast comes out, click that so you know whenever we upload one. That way you can get those first. We also put these on video. So if you want to see our bright shining faces and how we look in person, you can do that as well. Just head over to youtube.com and do a search for Money and Markets, and we'll be the one with the green logo. You'll find the Bull and the Bear podcast, the marijuana market update that we do each and every week, and our week ahead. All those videos are there, plus all the other videos that we put out. Make sure that you subscribe to our YouTube channel. Just click the subscribe button down at the bottom, and then you'll have a little notification bell that comes up. If you click that, that'll make sure that you get notified each and every time that we put out a new video, which is good because we put out videos first before we put them out on moneymarkets.com. If you have a comment or question, maybe a concern or a stock or a sector you'd like us to look at, email us at thebullandthebear@moneyandmarkets.com. That's thebullandthebear@moneyandmarkets.com. All spelled out, all one word. We'll try to put it in the video somewhere, and it'll be in the show notes as well. And make sure you're checking Money Markets each and every day. As Adam, Charles, myself, we try to write and give you sound investment information so that you make the best possible decisions with your money. So for Charles Sizemore, contributor of Money Markets, and Money Markets Chief Investment Strategist Adam O'Dell, I am Money and Markets research analyst Matt Clark. And until next time, everyone, safe trading.